Hey everybody, and welcome to the first day of the new financial year. We look back on what happened in June 2020 to the property market as a result of COVID impacts as it really started to hit, and see what you can do as a homeowner and investor in this current market. So let's dig into it. This presentation will cover the impact on the economy, property values, and some ideas on options forward for you. So just to introduce myself, my name is Mary, Director of Creatopia Constructions. If you overlook the fact that we've helped over 125 families and over $12 million in projects and more now, really why we're doing this presentation is because of our mission to help Aussies stop mortgage stress and reach financial freedom through property. And by having more knowledge being power, we believe that you will be in a better position to make a more informed decision for yourself. And also here, we want to present quality knowledge, not just any data that we can throw at you left, right, and center. So we've really curated and spent a lot of time in putting this together. And just a general disclaimer that this is general information presented. Please do your own research. We highly encourage it to make a decision for your own unique personal situation. And let's dig into it. So some good news, firstly, is that in June, we are starting to really see some stability in payroll jobs and wages. So these are existing jobs in existing companies and existing wages for existing employees, right? So as we saw in this chart you see here, the blue line just shows that when the pandemic started in mid-March, there was so much uncertainty that existing companies started to reduce the number of jobs and the number of hours worked by employees and workers. And also, as restrictions were introduced, businesses had to just really stop operations. Therefore, as a result, the existing wages paid to those employees and workers were decreased. However, as you can see, towards the end of May there, we're now starting to reach more stability. So what that means is as restrictions are starting to lift and people starting to pivot, change their business model, go online, there's more certainty. So therefore they are putting, not more hours back, but at least giving employees more certainty. Okay, this is the number of hours we're working and this is how we're going to operate now. So stability is always better than instability in terms of income. However, if we look at unemployment, bad news, it has continued to increase from June and from May. So it's now increased to 7.1% from 6 point something in May. And unfortunately, right now economists are forecasting that it will go up to about 10%. So we will see what happened there. But essentially, if you have a look at over the last 5 years in this graph, we have done really well as a country in Australia. So unemployment has been really, it's been up and down, but overall a downward trend from 2015 to about 2019. And really the only thing that rocked the boat, so to speak, was this COVID crisis. So there was nothing intrinsically wrong possibly with the Australian economy until the recession from this crisis hit. And ultimately, what this key metric will mean is obviously possibly decreased purchasing capacity for the property market. So that's why we look at this number very closely as property developers, investors. Another metric we look at is what's happening to businesses because they are really the backbone to household income, right? To what everybody's being paid. And out of all the businesses that ABS surveyed, these are some very scary stats for me personally because I see that 2/3 of businesses decreased in their revenue compared to the previous year. But what the next stat is highlighting is out of 1/3 of those businesses, their revenue decreased by 50% or more, right? So what that means is imagining your income halving, or because some businesses as gyms, salons, massage parlors. What else? I mean, a lot of cinemas. Essentially, they actually had to shut their doors, right? So, imagining your revenue going to zero. So, the fact that a very large percentage, a third of businesses had huge reductions in revenue, will obviously have carry on effects to what they pay their employees, as well as whether their businesses will even continue to operate. So we look at that in this little pie chart here. And by the way, sometimes you really need to dig hard. So we found this chart tucked away, not in the key metrics presented, but in one of the metrics. So what this is the business sentiment on how long they can continue to exist, how long they can continue to operate based on how much cash they currently have on hand. So what's really scary is almost 50% of businesses say that they will last less than 6 months, right? So only about over a third of businesses think they will last more than 6 months. And there's about 16% that don't know. So if you think in about 6 months, half of all businesses in the Australian economy shuts shop, then wow, like what's going to happen there? Obviously, this is only a little sample collected by the ABS. It's not reflected by every single businesses in Australia, but it's a little sample size that gives you a taste of what everybody is feeling. And out of these businesses, they then divide the businesses into small, medium, and large businesses based on like the number of employees. So small businesses is under 20 people, and about 30% of small businesses think they won't last more than 6 months. And then as the size of businesses increase, so medium-sized businesses and large size, so more corporations, their likelihood to survive is higher. So really, the biggest impact out of this low business sentiment is to the mom and dad businesses and small businesses. So some good news, I mean, despite this, is there's a lot more opportunity in terms of pivoting your business to more online based platforms. A lot of people have gone virtual. And also, I mean, if you look at the news, some Aussie manufacturers actually had a revival because people are requesting more work at home furniture and they want Australia made, and that's being exported not just interstate but also overseas. So that's fantastic. But from what you can see here, from all the businesses, that's only a small percentage. So there's majority of paying, small percentage that's doing really well and actually doing better in the current economy compared to before, really. And now we look at what's been happening to the property market. One of the key things we look at in terms of pricing and property value is consumer sentiment. So how happy people are feeling when they're thinking of buying stuff. And if you think about it, property is also one of those stuffs. It just is a lot more expensive and people attribute a lot more meaning to buying a home rather than just buying groceries or a bag or shoes or something. So if you have a look there, the little arrow just points you to the dip. So this chart, if you actually have a look, it's all the way from 2004 to now. So we had a big dip in March to May period. But now, if you look at the little recovery there at the end of May and June, it's shooting right up to even pre-COVID levels, which is fantastic. Because what that means is people are in a happier mood to buy properties and also groceries and bags and shoes and tools or whatever you have it. So what we actually see here on the chart is property values in major capital cities continue to decrease with some exceptions in the territories and also Hobart. But Melbourne, once again, similar to May, has been the worst hit capital city, and also Perth. Sydney, less so. And this trend is anticipated to continue downward by a lot of property experts. But if we once again look at really what's been happening to actual data, that just gives us a little hint to what will happen. So one of the things that the CoreLogic, so CoreLogic is a key property database company in Australia. So their head of data said that one of the things we need to look at is the number of listings for short-term predictions on the market. Because what that means is essentially, we look at supply and demand of properties. If there is a lot of listings on the market, there's a large supply of housing, but not enough buyers, that will create a deflationary effect on property prices. Obviously, the opposite, if there's not enough listings, there's low number of property stock on the market, there's stagnant or maybe high demand, therefore it will cause an inflationary or increase in property values, right? So let's have a look at this chart. Once again, some, I would say, relatively tentatively positive news that new listings are starting to creep back up. So that's the little orange line you see there on the left graph. And that is encouraging news, because what that means, I think also everybody is feeling it a little bit. Once again, uncertainty in the last couple of months, everybody's in lockdown quarantine. You didn't really want to put your property on the market unless you really had to, because, not many people going to open inspection. There was also restrictions on open inspections. And also, you're not guaranteed to get the best price for your property. So now that people have easing of restrictions, a lot more certainty, they are saying, okay, great, now it's time to put my property on the market. There was a little bit of a renovation blitz over the last couple of months as well. So maybe people have finished their renos over the lockdown period. It's ready to go. But that's just the new listings. What's more telling is on the right-hand side, if you look at the total listings chart, it hasn't moved too crazily. So once again, in previous webinars, I've explained, if you compare the little orange chart graph, which is 2020 to the previous years, there is a seasonal trend, right? Like, for example, in winter, usually there's less listings because it's winter, people don't want to be outside, There's all these practical reasons. And but if you look at this year compared to last year and previous years, clearly there's a lot less listings compared to last year and previous years. So that shows you there's not a lot of stock, as we were talking about before. And from a buyer perspective, is there demand, right? So unfortunately, we're not seeing a crazy amount of demand, because once again, people's jobs, livelihoods are impacted. So it depends on which sector you're looking at. First homeowners, first home buyers, their demand has decreased. So this is just what our company is seeing. But from an investor perspective, this could be a really good time to buy. So that's why the demand hasn't dropped off, but it hasn't increased. So my personal assessment of the situation is relatively stagnant. So the fact that there's new listings and relatively stagnant demand could mean that prices will continue to go lower, actually. So we will see. Next. So I presented this last month, but I wanted to present this again. It's a little model that the University of Melbourne did to predict what will happen to the property market. And pretty much they predict a decrease in home equity value. I got a lot of questions last month, so I just wanted to explain this chart, which could look a little bit confusing. So essentially, we are going to focus on the green bar for this month's presentation only, just to make things a little bit easier. So pretty much this is divided into the 5 key states that they analyzed. And if we start with New South Wales and the green bar, so it hits about negative 10%. So what that means is that green bar represents about 25% of properties in the New South Wales area. And the negative 10% means a negative 10% in their home value. So they think about, 25% of all homes and homeowners in New South Wales will experience a 10% decrease in home value. And the period for their estimations between March and September. So right now it's July already, so we'll see whether that is true. It's once again not for all homes. It's only about 25%, and the criteria for that 25% is depends on the mortgage situation scenario, and it's actually something also echoed by the head of data at CoreLogic. So as right now we're being carried by job seeker and job keeper government subsidies, so people's income, if they lost their jobs or if their employers can't pay their wages, the government has stepped in to pay those wages or give them support whilst they look for a job. So therefore, people's lives have stayed relatively constant. Okay, but what will happen when those subsidies end is the question. And especially for people in this 25%, it's people that have leveraged their homes with more loans. So, for example, if you've already had your home for 20 years or even 10 years and paid off both principal and interest, therefore you have a lower amount of mortgage to repay. Therefore, the Uni of Melbourne just explained that you're more likely in the 75% that won't experience the negative 10% decrease in your value. But if you have a larger mortgaged amount, or if you even have a second mortgage or refinance to take more equity out of your home, then there's more likelihood that homeowners are in this green bar, 25%. And therefore, if you look at the little green bar in Victoria, which is more than a 10% decrease, Queensland about 10%, South Australia less so, about 7.5% decrease. Western Australia, unfortunately, we're seeing the actual data and this model, they expect a more than 20% decrease in home values. So it just really, it's a case-by-case scenario, but mainly based on how much people are leveraged in their mortgage. And as we explained before, that the subsidies are due to end currently around the end of September. And there was a comprehensive review by the Scott Morrison government on what the future plan is, because everybody wants, or most people, I won't say everybody, there's been a large majority that want the subsidies to continue, but it's not in the government's interest because they're in so billions and hundreds of billions of dollars in deficit. So they are not announcing anything yet. There was a review that was completed at the end of June as to what will happen next, and they will announce their decision to the public on the 23rd of July. So we'll keep you updated in our August update. And then, once again, what we will see potentially when this ends is an increase in mortgage arrears. So the total amount unpaid on someone's mortgage. So what happened in the last couple of months is people went on these so-called mortgage holidays, but it's really not a holiday. It's a holiday with a price to pay. And I think a lot of people don't realize that, because a deferral in your mortgage doesn't mean that you don't have to pay for it. It means you pay for it later, and you actually accumulate more interest. So you have to pay more later. So it doesn't feel like there's any pain now because the banks, are in a state where they understand COVID has hit the entire country and the entire world. However, they are not going to be understanding forever. And once the subsidies run out and once the understanding of banks, if we can call it that, ends around that period of September, very scary what will happen next. And therefore, CoreLogic also said that unfortunately there could be an increase of supply of new listings to the market because people will be forced to sell their homes in order to, one, not lose their homes to the bank, and also two, to obviously get some cash so they can continue to live, whether they've lost their jobs or had a decreased income from their employment. So the next one, we were very excited about this last month, which is home builder grants, right? For new builds and renovations. Unfortunately, it's been about a month now. It's not actually active. People got really excited and go, "Whoa, I can apply for my new house I'm building," and or for renos if you're renovating something more than $150,000. Yes, that's a minimum. Then yes, they will offset part of that $150,000 or more with about $25,000. But it's not active. None, essentially, in order for people to apply and get the actual money in their bank account, the state that they're in have to sign on. And not all states have signed on. And my latest guide is that all states have to sign on in order for the federal government to say, okay, it's a go. So yeah, this is not a stimulus right now, in my personal opinion, because it's not working. So once it starts, people actually start to receive this and in their bank account. That's when I think this actual grant and stimulus works. So right now, coming back to you, we'll have a quick exercise to help you with navigating in this current environment. And once again, the question most important to you is, what is your personal priority right now, right? That could be different for everybody. So here are just some examples, right? Do you want to just keep your current income, cash flow, keep up your mortgage payments, bills, stay put? Some people's needs are just basic needs, like I just want to keep food on the table. Some people want to keep their good credit rating, because FYI, if you actually put your mortgage on hold, that does affect potentially your credit rating. Surprise, surprise. So if you are a little bit concerned, highly recommend you contact your lender. And also you can do a free credit report online. Just go to Google and type in free credit report, and you can actually see what your current credit rating is. I just heard some horrible stories from mates that they put their mortgage on hold. The bank said, nope, it won't affect your credit rating, and their credit rating actually halved. So I hope that's not your story. And finally, the focus for this presentation is, how do we help you position yourself and secure yourself for the uncertain future? Because right now, as things are starting to have like a good recovery trend, possibly, it's still not guaranteed. And right now, as I'm speaking, certain parts of Melbourne is going back into lockdown. So we don't really know anything still for sure. So how do we still secure ourselves? So hopefully you guys have heard of this, but if not, this is called a SWOT analysis. And then I'll just quickly explain this, and you can do this after the webinar at your own time, right? So acronym for S, strength, W, weakness, O, opportunity, and T is threat. And this very useful table also says internal, external, helpful, harmful. So pretty much from a property perspective. So firstly, where are you? Are you a homeowner? Are you an investor? Are you a developer? Like where are you right now? What is your personal goal and your priority? And out of that, let's look at the current market, right? So from a personal and internal perspective, what are your strengths and weaknesses as a property owner or property investor? So for example, myself, I feel like my strength would be analytical, as well as I would say I love being interpersonal and talking to people. So that's my strength. Weakness is possibly I have too much of a detail to info. Sometimes I get really bogged down in the details. So you need to know where you stand. But in terms of from where you are, and then also some other strength would be I have cash on hand. Yeah, fantastic. Or weakness could be, if you don't have cash on hand, I don't have cash on hand. That could be a weakness from a property perspective. Externally, opportunities are plenty. So this is a good time to, if you're looking to invest or buy your first home, is this a good time to buy? Because potentially there would be a decrease in property price. But however, if you're an existing homeowner and you're thinking, oh, I may have to sell, then that's potentially a threat, a decrease in property value, which is out of our control, right? The market value. But an opportunity could be, okay, well, I have an older house, old home, and I could actually improve its value. So that's an opportunity. Irrespective of what the market does, I can still, give it a coat of paint. I can still, refurbish all the fittings and all the appliances. So that will still increase your home value, definitely. And threats could be, well, I want to do that, but once again, the weakness I had before was low cash on hand. So just know where you are, and just once again, on a piece of paper, you can just draw this table and quickly do this, or take you a couple of minutes, but it will give you a very clear picture, and clarity is power on where you are. And from where you are, we can now go to where you want to be, right? So some options I've also presented is just know where you are. Have you sought help? Especially with the government grants and bank assistance, if you have sought help, just to know that how long will the grant last if that's the thing that you're depending on, and with the bank assistance, what will happen after deferring your loan, because as I said before, that actually means more interest. And if you have any questions about the SWOT analysis exercise we just did with you, speak to an expert. So we are actually offering viewers, if you got to this point, free consultations worth $150, because last month we offered 10 free consultations. We actually got like 25 calls, and therefore we ran out, sorry, for a lot of the people that called us. So this month we unfortunately only are giving the free consult to 5 people, because it was so popular that we thought, okay, let's just dial this back a little bit and see how we go. And then if we can actually support the 10 people from last month and also the 5 people from this month and put on more staff, then we'll increase that number as well. So give us a call, 1-800-960-158, or give us an email to claim your spot. I would recommend giving us a call, because as I said, this was pretty much gone within the first hour of us launching this on like YouTube. So if you want to make sure you don't miss another opportunity, make sure you subscribe to our YouTube channel, as well as like our Facebook page, or LinkedIn or Instagram, to make sure you're connected with us so you don't miss another opportunity. Hopefully this month has been enlightening to you and helpful to you in terms of what we presented. Always happy to take your suggestions and comments on board to see how we can support you better. Have a fantastic July, everybody.